Hi, dear. Welcome to your favorite audiobook channel, Wisdom Flicks. Trading Mindset. No more luck, how to think like a pro trader. This is not about guessing or hoping. It's about mastering the mindset, emotional control, and discipline that turn trading into a skill, not a gamble. If you're ready to stop leaving your success to chance and start trading with purpose, focus, and confidence, this audiobook is your blueprint. Get ready to think like a pro trader. No more luck, just results. Introduction. Trading is a mental game. Trading is not just about charts, numbers, or strategies. It's not about the indicators you use or the news you follow. It's about how you think, how you react, and how you manage yourself under pressure. At its core, trading is a mental game. And just like any high-performance activity, whether it's elite sports, military operations, or space exploration, those who succeed aren't just technically skilled, they are mentally prepared. For many, trading begins with excitement. The thrill of the market, the dream of financial freedom, the possibility of turning a small account into a life-changing sum. But that excitement often fades when the reality sets in. The losses come faster than expected, emotional swings take over, and discipline quickly breaks down. What separates the winners from the losers in trading isn't some secret indicator or a hidden pattern no one else knows about. It's mindset. It's the ability to stay focused when everything is chaotic. It's the discipline to follow a plan when your emotions beg you to abandon it. It's the patience to wait for the right opportunity instead of forcing a trade out of boredom or desperation. Most people treat trading like gambling. They rely on luck, on hunches, on the hope that the market will somehow bend to their expectations. But professionals know better. They know that success in trading comes not from predicting the future, but from managing risk, mastering emotions, and executing a proven edge with consistency. They know that a single winning trade means nothing if your mindset is fragile and your habits are undisciplined. Think of trading like a mirror. It reflects back to you all your inner weaknesses: impatience, fear, greed, insecurity, overconfidence. It exposes your personal tendencies and magnifies them. If you're impulsive, the market will punish you. If you're hesitant, it will leave you behind. If you chase perfection, you'll miss opportunities. The market doesn't care who you are, but it will test who you are. The truth is, the greatest challenge in trading is not the market. The greatest challenge is you, your emotions, your thoughts, your habits, your mindset. And that's exactly what this book is about. This is not a book about technical analysis or strategy. It's not a guide to chart patterns or entry setups. You can find those anywhere. This book is about the invisible side of trading, the internal game. It's about rewiring how you think, training your emotions, and learning to operate like a professional in one of the most emotionally demanding environments that exist. That you'll learn how to detach from outcomes and stay focused on process, how to think in probabilities instead of certainties, how to handle loss without falling apart, and how to ride success without getting arrogant. You'll discover how pro traders develop routines, rituals, and mental frameworks that support consistent performance over time. This book is for anyone who's tired of depending on luck. It's for the trader who wants to stop gambling and start thinking like a professional. It's for those who understand that lasting success in trading isn't about finding the perfect system. It's about becoming the right person. In the chapters that follow, we will break down the core mental traits and psychological principles that define top traders. You'll find insights, exercises, and mindset shifts that can help you build a solid mental foundation, one that doesn't crack under pressure. Because in the end, trading is not a game of luck, that it's a game of mindset. And those who win it master their mind long before they master the market. Let's begin. Chapter 1. Luck versus Logic. The amateur's trap. Every trader starts somewhere. Some begin with curiosity, others with desperation. But most begin with a dream, an idea that maybe, just maybe, this is their ticket to financial freedom. And in that beginning phase, something interesting often happens. The first few trades are winners. Beginner's luck. It's real, and it's dangerous. That early taste of success is what traps many amateurs. A trade goes in their favor, not because they understood the market, not because they followed a plan, but because the timing happened to be right. The market smiled on them for a moment, and in that moment, a seed is planted. It's the belief that success in trading is just about being lucky, or feeling the market, or jumping in when it feels right. This is the beginning of the amateur mindset, and it's exactly what separates those who stay stuck from those who rise to the level of professionals. The amateur relies on luck. The professional relies on logic. Let's take a closer look at what that means. The illusion of control. Amateurs often believe they have more control over outcomes than they really do. They think if they stare at the charts long enough, a pattern will speak to them. They click the buy button based on a hunch, or because they saw someone else make that trade in a YouTube video. And when it works out, they believe they're onto something. But what they're really doing is gambling. Not intentionally, but psychologically. It's no different than pulling a lever on a slot machine. No risk management, no defined system, no clear reasoning, just hope. This is the first trap, the illusion of control based on randomness. In contrast, professionals understand that they have no control over the market, only over themselves. They don't try to predict the future with certainty. They think in terms of probabilities, risk, and logic. They know that even the best setups can fail. What matters is not one trade, but a consistent, repeatable process that plays out over time. The dangers of random wins. Winning randomly is worse than losing deliberately. Why? Because random wins build false confidence. They reinforce bad habits. The trader thinks, I made money, so what I did must be right. But just because you made money doesn't mean you made a good decision. And just because you lost money doesn't mean you made a bad one. This is a hard truth to accept. Imagine a poker player who wins big on a terrible hand. If he lets that win define his strategy, he's doomed. He's chasing luck, not playing the odds. It's the same in trading. If you build your mindset on random wins, you'll eventually lose everything. Not because the market is against you, but because your approach has no logic, no edge, no discipline. Trading without a plan. Another trait of the amateur is trading without a defined plan. They enter trades because the price is moving fast, or because someone in a Telegram group said it was going to explode. There's no thought behind the entry, no strategy behind the exit. And when the trade goes against them, panic sets in. They freeze. They add more money. They hope. This cycle repeats, sometimes for years. Professional traders, on the other hand, don't trade without a plan. Every trade has a reason, a risk limit, a target, and an exit strategy. And if the trade doesn't meet their criteria, they simply walk away. It's not emotional. It's logical. They know that trading is about probabilities, not predictions. The psychological shift. So, how do you shift from the amateur's mindset to the professional's mindset? It begins with one simple but powerful belief. You are not in control of the market. You are only in control of your decisions. This mindset shift changes everything. When you stop trying to guess what the market will do and instead focus on building a plan that gives you a consistent edge, you remove the need to be right. You trade from logic, not ego. You no longer need every trade to win. You simply need your edge to play out over a large number of trades. This is how casinos win. Not every spin of the wheel, but over time. They know the math. They trust the process, and they manage the risk. You must do the same. Stop thinking in absolutes. One of the biggest mental traps for new traders is thinking in absolutes. This trade must go up. The market can't go any lower. I know it'll bounce from here. This kind of thinking is emotional and irrational. It leads to stubbornness, overconfidence, and refusal to cut losses. Professionals, on the other hand, think in if-then logic. If the price breaks this level with volume, then I'll enter. If it drops below my stop, then I'll exit without question. If the trade hits my target, then I'll take profits. No hesitation. They operate from a place of structure, not stubbornness. And structure is what saves you when emotions run wild. Your job is not to be right. Let this sink in. Your job as a trader is not to be right. Your job is to follow a process that gives you an edge. Amateurs obsess over being right. They hold losing trades longer than they should, just to prove a point. They double down because they need to win. They confuse outcome with process. Professionals don't care about being right. They care about making good decisions. They know that some trades will win and some will lose. It's not personal. It's probabilities. They measure success not by the result of a single trade, but by the consistency of their mindset and execution over time. Logic creates longevity. Luck may bring you a win, But only logic builds a career that if you want to trade for the long run, you must leave behind the amateur's obsession with luck, guessing, and emotional attachment to trades. You must build a mindset grounded in clarity, logic, and a commitment to process over outcome. That's the foundation of every great trader. And it begins with one decision: to stop gambling and start thinking that you're not here to play a game. You're here to play the long game, with discipline, with strategy, and most importantly, with the right mindset. Let go of luck. Embrace logic. That's the path forward. Chapter 2. The real difference between a gambler and a trader to the untrained eye. A trader and a gambler can look almost identical. Both risk money. Both hope for profit. Both live with uncertainty. But beneath the surface, their intentions, decisions, and outcomes couldn't be more different. One is building a system for long-term, sustainable success. The other is chasing short-term thrills. One is focused on strategy, probability, and process. The other is guided by emotion, impulse, and luck. Understanding the difference between the two isn't just important, it's essential. Because if you're trading like a gambler, no amount of chart knowledge or market insight will save you. This chapter will show you how to recognize the habits, thoughts, and behaviors of gamblers versus traders, so you can leave the casino mindset behind and step into the mindset of a professional. The gambler's mindset. The gambler is driven by excitement. They crave the rush of uncertainty, the thrill of winning, the fear of losing. Their decisions are emotional, impulsive, and often based on little more than a gut feeling. They don't keep records. They don't track performance. They don't care about probabilities. Only possibilities. The gambler, the market, is a game of chance, a spin of the wheel, a flip of the coin, and that belief is what ruins them. Here are some classic behaviors of a gambler in the market. They over-leverage, putting too much capital into a single trade, hoping for a big win. They revenge trade. After a loss, they immediately jump back in, trying to win it back. They lack a plan. They enter trades without clear rules for entries, exits, or risk. They chase price, jumping in late just because the market is moving fast. They get emotional, letting fear and greed control their decisions. First, the gambler might even make money, but eventually, their luck runs out. And because they don't have a system, a plan, or a disciplined mindset, they give it all back, and often much more. The trader's mindset. A trader is not here for excitement. They are here for consistency, where the gambler acts on impulse, the trader acts on intention. Where the gambler hopes, the trader calculates. Where the gambler reacts, the trader follows a plan. The trader understands that risk is part of the game, but they don't play games. With risk, they treat trading like a business, not a bet. Here's what the mindset of a trader looks like. Risk is predefined. Before they enter a trade, they know exactly how much they're willing to lose. Every trade fits a plan. They only trade when specific conditions are met. They think in probabilities. No trade is guaranteed, so they focus on consistency over time. They log every trade. Wins and losses are studied, not ignored. They stay emotionally neutral. No trade defines them. They never get too high or too low. Traders understand that even the best setups can fail. They accept this. They don't fight it. They simply control what they can, how much they risk, when they enter, when they exit, and how well they follow. Their system, same tools, different outcome. A gambler and a trader might use the same tools: charts, indicators, news feeds, trading platforms. But the outcome is completely different. Because it's not the tools that determine success. It's the mind that uses them. A gambler uses tools to justify impulsive behavior. A trader uses tools to execute a plan with precision. The same chart pattern that leads a gambler to blindly enter a trade could lead a trader to patiently wait for confirmation. Check volume, assess risk, and only then decide whether it's worth taking. It's not the market that makes the difference. It's the mindset behind the monitor. The illusion of skill. One of the most dangerous things a gambler does is mistake luck for skill. They hit a few big wins early, and they begin to believe they have a feel for the market. Their confidence grows, but their risk management doesn't. They begin to scale up, overtrade, and ignore warnings. Eventually, reality catches up. This illusion of skill is what takes many traders down. Professional traders don't fall into this trap. They don't confuse outcome with process. They know that a good trade can lose, and a bad trade can win. So, They judge themselves not by the results of a few trades, but by how well they followed their process. That's the key difference. Gamblers are results-driven. Traders are process-driven. Accountability and awareness gamblers blame the market. They blame news. They blame algorithms. They blame anything but themselves. And because they never take responsibility, they never improve. Traders are different. They take full accountability for every decision. If a trade goes wrong, they ask, did I follow my plan? Was my risk management correct? Did I learn something useful? This awareness leads to growth. And growth in trading is everything. There is no such thing as a perfect trader, only a constantly improving one. And that improvement only happens when you stop blaming and start reflecting. Addicted to the wrong things, gamblers are often addicted to the adrenaline, the noise, the action. They measure progress by how active they are, not how disciplined they are. Traders are addicted to something else entirely. Clarity. They crave quiet, patience, calm execution. They're not in the market to be stimulated. They're in it to grow wealth systematically. If you find yourself needing to be in a trade just to feel engaged, pause. Ask yourself, are you trading to win, or are you trading to feel? Professional traders can sit for hours, sometimes days, without taking a single trade. Why? Because they know that doing nothing is often better than doing something random. The market pays discipline. It punishes desperation. Reframing risk to the gambler. Risk is thrilling. The trader. Risk is something to respect. Gamblers take big risks hoping for big rewards. Traders take calculated risks based on statistical edges and probability. 1. Approach burns out accounts. The other builds them over time. A gambler might risk 30% of their account on one trade. A trader risks 1 or 2%, knowing that their edge only plays out over a large sample of trades. Gamblers think short-term. Traders think long-term, and that's where the real difference lies. From gambler to trader, the transformation. If you recognize the gambler in yourself, don't be discouraged. Almost every great trader started there. What matters is that you evolve, that you recognize the difference, that you begin to shift how you think, how you prepare, and how you respond. Here are some practical ways to start making the shift. Create a written trading plan. Define your setups, your risk per trade, your rules for entry and exit. Track every trade. Start a journal. Record what you did, why you did it, and what happened. Set a maximum daily loss. Once it's hit, walk away. No exceptions. Analyze. Weekly. Look for patterns in your behavior, not just in the market. Detach from outcome. Focus on the quality of your decisions, not whether a trade won or lost. This transformation takes time, but it begins the moment you stop chasing luck and start thinking like a professional. Trading is not a game of chance, it's a game of consistency, discipline, and mental strength. Leave gambling to the casinos. You're here to build something real, and it starts with mindset. Chapter 3. Building a winning psychology. The market doesn't reward intelligence alone. It doesn't care how much you know about candlesticks, moving averages, or economic indicators. It rewards those who can master their mind under pressure. Because when money is on the line, your greatest enemy is rarely the market. It's your psychology. Winning in trading is not just about having a system. It's about having the mental strength to stick to that system when everything inside you is begging you to do the opposite. That's what separates winners from everyone else. They've built a psychology that supports success, not sabotages it. Why mindset comes before strategy. Many traders search endlessly for the perfect strategy. They hop from one system to another, thinking the next setup or secret indicator will finally bring them consistent profits. But even the best strategy will fail if your mindset is weak. Think of it like this. Your strategy is the vehicle, but your psychology is the driver. A Formula One car in the hands of an untrained driver crashes. But a regular car in the hands of a disciplined driver reaches the destination. It's not just what you trade. It's how you think while trading that determines your results. The 3 core pillars of a winning psychology. A winning psychology rests on 3 main pillars: self-awareness, emotional regulation, and mental discipline. Let's explore each. 1.1. Self-awareness. Know thyself. Before you can master the market, you must master your reactions to it. That begins with understanding your own behavior patterns. Do you hesitate to pull the trigger when the setup is perfect? Do you chase trades out of fear of missing out? Do you panic when the trade moves against you? Do you get overconfident after a big win? Self-awareness means recognizing your psychological tendencies before they lead to mistakes. It means stepping back from the screen and asking, what am I feeling right now and why? Winning traders are not robots. They have emotions, but they don't let emotions control their decisions. They observe their thoughts and feelings without becoming slaves to them. You can't fix what you don't see. So start seeing point 2. Emotional regulation. Feelings are not facts. Your emotions are real, but they are not always relevant. Fear, greed, anxiety, frustration, these emotions are natural. But if left unchecked, they can drive impulsive decisions, cause hesitation, or lead you to abandon your plan entirely. To succeed in trading, you need to learn how to feel your emotions without reacting to them. This is emotional regulation. It's the ability to sit with discomfort without letting it dictate your actions. It's the discipline to cut a loss even when it hurts. It's the calm that allows you to stay patient while others are panicking. Point 1. Of the most powerful things you can do as a trader is to pause. Before entering a trade, pause. Before adjusting a stop, pause. Before reacting to a losing streak, pause. That moment of stillness gives you space to make a conscious choice instead of an emotional reaction. The trader who can control their emotions has an advantage over 90% of the market. Point 3. Mental discipline. Do what needs to be done. Discipline is doing the right thing, especially when it's the hard thing. Most traders know what they should do. Wait for the setup, respect the stop loss, take profits when the target is hit. But knowing and doing are two different things. The space between those two is filled with discipline. Mental discipline is what keeps you consistent in the face of chaos. It's the ability to follow your rules on your worst day, not just your best one. It's sticking to your edge even when you've had 5 losers in a row. It's walking away when there's no trade, even if you've been sitting for hours. Discipline is not about being perfect. It's about being reliable. The market is unpredictable. You can't control that, but you can control your process. And that's where consistency begins. The importance of routine and structure. Winners don't just show up, they prepare. They build routines that support performance. A strong psychology thrives in structure. Start by creating a pre-trading ritual. Review your plan. Meditate or breathe to calm your mind. Check your mental state. Are you calm or agitated? Remind yourself, I don't need to trade. I need to wait for my trade. Create a post-trading process too. Log your trades. Reflect on your decisions, not just the results. Identify what went well and what didn't. Reset for the next session. Routine builds consistency. Consistency builds confidence. Confidence builds results. Detachment, caring less. Winning more. The more attached you are to an outcome, the more likely you are to make poor decisions. When your self-worth is tied to a trade, you'll bend your rules to protect your ego. When your happiness depends on a green day, you'll force trades to avoid feeling like a failure. Detachment doesn't mean you don't care. It means you're not emotionally entangled. You can care deeply about your trading success while staying detached from any single trade. This is the paradox of trading psychology. The less you need to win, the more clearly you can see what actually works. Trade as if nothing is owed to you. Trade as if any trade can fail. Trade with acceptance, not expectation. That's when you begin to move like a professional. Identity, who you believe you are. Every action you take in the market is a reflection of how you see yourself. If you see yourself as a disciplined, focused, professional trader, you'll act in alignment with that identity. Even when things get hard, if you see yourself as someone who always messes up, who can't control emotions, who doesn't stick to plans, that identity will quietly sabotage you over and over. So here's a question. Who do you want to become? Start acting like that trader today. Even if you're not there yet, you can align your actions with that vision. With repetition, your brain rewires, your identity shifts, and your performance follows. Winning psychology is not something you're born with. It's something you build. Progress over perfection. You will make mistakes. You will break rules. You will have emotional days. That doesn't disqualify you from becoming a professional. What matters is how you respond. Do you reflect and grow? Or do you blame and repeat? Progress is not linear. It's messy. But with every mistake, you get better. If you choose to learn. So give yourself grace, but never give yourself excuses. Push for improvement, not perfection. Final thoughts. Build from the inside out. Too many traders focus on fixing the outside, tweaking strategies, adding indicators, jumping from system to system. But the real breakthrough happens when you fix what's inside. Because when your psychology is solid, you follow your edge with confidence. You recover quickly from losses. You stay calm during chaos. You trade less, but win more. You grow, no matter what the market does. This is what separates amateurs from professionals. Not luck, not strategy, but mindset. You build a winning psychology the same way you build any strength, with intention, repetition, and patience. Keep building. The mind you shape today becomes the trader you are tomorrow. Chapter 4. Emotional Control. Mastering the inner battlefield in trading. Your greatest battle is never against the market. It's against yourself. The flashing screens, the fast-moving candles, the constant noise of the financial world. All of it is designed to pull your attention outward. But the real fight happens inward. Within your thoughts. Within your emotions. Within that quiet space between impulse and decision. This is where traders are made or broken. The truth is, you can't eliminate emotions. You're human, and humans feel. But you can control emotions. You can master your response. And if you want to trade like a professional, emotional control is not optional. It's essential. The two emotions that destroy traders. There are many emotions that surface in trading, but two dominate above all: fear and greed. Fear comes in many forms. Fear of missing out, FOMO, which leads to chasing trades too late. Fear of losing, which causes hesitation and missed opportunities. Fear of being wrong, which keeps traders clinging to bad trades long after they should have exited. Fear paralyzes or pressures. Either way, it clouds judgment. When fear runs the show, traders make defensive decisions. They cut winners too early. They move stop losses too soon. Or worse, they stop trading altogether, convinced that every move they make will fail. Greed is equally destructive. Just on the opposite end of the spectrum, greed pushes you to overtrade. It whispers, one more trade, even when your setup is no longer valid. It tells you to double your risk, to ignore your plan, to let a trade run longer than it should. Greed makes you believe you're invincible after a few wins. It inflates your confidence, blinds you to risk, and often leads to emotional wipeouts. Ironically, both fear and greed come from the same root: a lack of control over your emotional state. And the only way to overcome them is to build that control from the inside out. Recognize before you react. The first step to mastering emotion is recognizing it before reacting to it. Emotions aren't the enemy. Blind reactions are. The moment you feel tension rising in your chest or your hands reaching impulsively for the buy button, pause. Ask yourself, what am I feeling? Why am I feeling this? Is this emotion helping or hurting my judgment right now? This split second of reflection is your greatest tool. It creates space. And in that space, you take back control. You can't stop the waves, but you can learn to surf them. Emotional triggers and market behavior. Certain market behaviors will trigger specific emotions in you. Fast-moving trends might spark excitement. Sudden reversals might bring panic. Boring sideways action might lead to impatience. Start to track your emotional triggers. Notice what kinds of price action make you uncomfortable. Which situations cause you to break your rules. Which patterns bring confidence, and which bring chaos. Self-awareness isn't just a psychological concept. It's a trading edge. The more you understand your emotional tendencies, the more you can prepare for them in advance. That it's not just about reading charts. It's about reading yourself. Create a space between feeling and action. Between every emotion and action, there is a moment, a small window of choice. The amateur reacts. The professional pauses. That pause is everything. It's the moment where fear can turn into discipline, where greed can transform into clarity, where the urge to act is replaced by the wisdom to wait. Building this space takes practice, but once you develop it, you gain a superpower: emotional freedom. You're no longer a puppet of your feelings. You're a strategist, choosing your moves with intention. The role of routine in emotional stability. Emotional control is not just about what you do during trades. It's also about what you do before and after. Establishing a pre-trading routine creates stability. Just like an athlete warms up before a game, a trader should prepare the mind before entering the market. Here's a simple framework. Review your trading plan. Take a few deep breaths to center yourself. Visualize calm decision-making under pressure. Remind yourself, I don't control the market, only my actions. When you start the day with emotional clarity, you're less likely to be thrown off by randomness or volatility. Likewise, end your trading day with reflection. What emotions came up today? Did I act from discipline or impulse? What can I improve tomorrow? This practice turns trading from chaos into craft. Over time, it builds resilience. Detachment from outcomes. One of the biggest emotional traps is attaching your identity to results. When a trade wins, you feel proud. When a trade loses, you feel ashamed. But this emotional roller coaster is unsustainable. You'll burn out. Or worse, you'll start making decisions to feel better, not to trade better. Detachment means you care about trading, but you don't let it define you. A loss doesn't mean you're a failure. A win doesn't mean you're a genius. Both are just part of the process. The only thing that matters is how consistently you follow your edge, manage your risk, and make high-quality decisions. Let go of needing every trade to be a winner. Let go of needing the market to validate your worth. The more detached you become, the clearer you trade. Building emotional strength over time. Like muscles, emotional strength is built through repetition. Every time you wait for your setup instead of chasing a trade, you grow stronger. Every time you cut a loss without hesitation, you build discipline. Every time you stick to your plan despite market noise, you train resilience. Emotional control isn't a switch, it's a skill. A skill that improves each time you choose logic over reaction, discipline over impulse, process over outcome. Your mind won't always feel calm. But the more you train it, the more you'll be able to act calm, even when everything around you feels unstable. That's what professionals do. The calm trader wins. The calm trader is dangerous. Not because they're aggressive, but because they're in control. They don't chase trades. They don't panic on pullbacks. They don't get euphoric during runs. They follow their rules. They manage their risk. And they make decisions from a place of clarity, not chaos. This calmness isn't accidental. It's intentional. It's trained. It's earned. And it's available to you. No matter where you are in your trading journey, emotional control is something you can develop starting now. You already have the tools. Pause. Breathe. Reflect. Decide. You're not just trading charts. You're trading your mind. And when you win that battle, the rest follows. Chapter 5. Developing patience. Like a sniper in the world of trading, patience isn't just a virtue, it's a weapon. A sniper doesn't fire at everything that moves. He waits, still, focused, calm, watching his target through the scope with complete control over his breathing, his nerves, and his instinct to act. He doesn't fire because he can. He fires because it's the right moment. The same principle applies to trading. The illusion of constant action. One of the biggest traps amateur traders fall into is the need to be constantly doing something. They equate action with progress. They believe that every minute not spent in a trade is a minute wasted. But this is not trading. This is gambling with a screen in front of you. Professional traders understand that the real game is not about how often you trade, but about how well you wait. Waiting for the right setup. Waiting for confirmation. Waiting for your emotions to align with your rules. The market will present countless opportunities that look good but don't feel right. The impatient trader takes the bait. The patient trader watches, evaluates, and refrains. The power of selectivity. The sniper trader has a well-defined strategy and filters. They don't chase every signal or swing wildly at the market's noise. They are selective, only taking trades that meet all their criteria. Not some, not most, all. This selectivity does not come from fear, it comes from strength. The strength to wait, the strength to say no, the strength to believe that the market will come to them, not the other way around. Think of your trades as bullets. You don't have an infinite supply. Each one must count. Every time you enter a trade prematurely, you're reducing your mental capital and emotional bandwidth for the one that could actually change your account. Emotional impulses versus strategic timing. Impatience is often fueled by emotion, fear of missing out, frustration from a losing streak, boredom from waiting too long. These emotional states are dangerous because they push you into trades that your logical mind wouldn't normally take. True patience in trading is not passive. It's active control over impulsive desires. It's about aligning your strategy with your state of mind. Here's a simple rule to test your patience. If you feel excitement, urgency, or tension before placing a trade, step back. That's not discipline speaking, it's emotion. A sniper doesn't get excited before pulling the trigger. He gets calm. So should you. Learning to sit on your hands, one of the most powerful trading lessons, is learning to do nothing when there's nothing to do. Just like a sniper in position, the best move is often to sit and observe. This doesn't mean you're lazy or indecisive. It means you understand that timing is everything. Great trades don't come every day. Sometimes they don't come for weeks. But when they do, they often make up for the entire waiting period, and then some. The trader who has the patience to wait for those high-probability setups is the trader who wins consistently. Patience is preparation. A sniper doesn't just wait in silence. He checks his scope, controls his breathing, adjusts his aim. In other words, he prepares while he waits. In trading, patience also means reviewing your plan, analyzing past trades, journaling your emotions, and building your skills. Use the waiting periods to become sharper, calmer, and more aligned with your strategy. Let your preparation during idle moments be what makes you lethal when the time to strike arrives. Building your patience muscle, like any mental skill, patience can be trained. Here are a few ways to build it. Backtesting. The more historical data you review, the more confidence you'll build in your setups. Confidence reduces the need to force trades. Meditation or breath work. This helps you regulate your nervous system and stay calm during moments of high tension. Delayed entry rule. Implement a rule that forces you to wait a set period, e.g., 10 minutes, after spotting a setup before you can enter. This trains your self-control. Journaling. Track every trade you entered impulsively versus those you waited for. Reflect on the outcomes. This will help you internalize the value of patience. Final words: impatience is expensive. In trading, it costs you money, mental clarity, and long-term growth. Patience, on the other hand, builds consistency, confidence, and compound gains. The sniper trader doesn't flinch, doesn't chase, doesn't react to noise. That he waits for the perfect shot. So must you. Patience is not about being slow. It's about knowing when not to act and having the discipline to stand still until the market gives you the green light. Wait for your shot, then take it with precision. Chapter 6. Confidence without ego. Confidence is the fuel that drives consistent performance in trading. It's the silent belief that your plan works, your edge is real, and your preparation has meaning. But confidence, when poisoned by ego, becomes a liability. True confidence is quiet, controlled, and self-assured. Ego, on the other hand, is loud, defensive, and driven by the need to be right. In trading, the difference between the two can make or break your long-term success. The anatomy of confidence. Confidence in trading isn't about thinking you'll win every trade. It's about knowing that over a series of trades, your strategy, executed with discipline, will lead to positive results. It's rooted in logic, practice, and results. Confidence grows from mastery of your trading system, a clear understanding of risk, emotional discipline, accepting uncertainty. This is not blind optimism. It's measured belief in your ability to follow your rules, manage risk, and accept losses when they come. The trap of ego. Ego is the false friend that whispers, "You can't lose." Ego is not based on facts or discipline, but on the emotional high of recent success. It tells you that your intuition is better than your plan. It encourages you to take bigger risks because you're on a winning streak. And when things go wrong, ego resists accountability. It blames the market, the news, or the broker. A trader ruled by ego over-leverages after a win, holds on to losing trades to prove a point, ignores stop losses, seeks validation from being right. Ego needs to win now. Confidence is okay with winning over time. Humility. The foundation of long-term confidence. Professional traders understand that the market can humble anyone at any moment. That's why their confidence is paired with humility. They don't assume they're smarter than the market. They assume they need to stay sharp, focused, and respectful of risk. Humility in trading means you can be wrong and still be a great trader. You let the market tell you when you're right. You adjust, adapt, and keep learning. This humility strengthens confidence because now you're not defending your ego, you're refining your skill. How to build confidence without ego. Stick to your system. Confidence builds when you trust your plan, Every time you follow your rules, win or lose, you reinforce that trust. Consistency leads to clarity. Detach from being right, focus on making good decisions, not perfect predictions. You can be wrong and still manage the trade well. That's what counts. Journal your trades, writing down your reasoning and reviewing it regularly helps separate logic from emotional impulse. This builds confidence in your thinking. Embrace feedback, review your performance honestly. What worked? What didn't? Where did emotions creep in? Self-auditing weakens ego and strengthens your trading mind. Respect every trade, don't get casual or cocky after wins. Every trade deserves the same focus, planning, and risk management. Learn from others, study great traders. You'll notice a common trait. They're confident, but never arrogant. They've lost, recovered, and grown. Their wisdom comes from experience, not ego. Recognizing ego in real time, learn to catch ego before it takes over. Do you feel invincible after a big win? Are you overriding your rules because you just know this trade will work? Are you increasing size to chase losses or prove yourself? If so, pause. Walk away. Reconnect with your process. That a confident trader can say, I don't need this trade to work. I just need to trade well. The inner dialogue of a confident trader. A confident trader's mind is steady. They speak to themselves like a coach, not a critic. They say, stick to the plan. One trade doesn't define me. Stay patient. Let the setup come to you. It's okay to miss a trade. It's not my last opportunity. This inner dialogue quiets the noise of fear and ego. It keeps the mind clear and focused on execution. Final thought. Quiet power. The best traders don't brag. They don't chase. They don't need the market to make them feel good. Their power comes from within. Quiet, disciplined, and resilient. Confidence without ego is like a sniper with a steady hand. Calm, clear, and patient. That's the mindset you need to survive and thrive in the market. When you trade with true confidence, you stop needing the market to validate you. You trade for progress, not pride. You become a professional. Chapter 7. Discipline. The invisible superpower. When people think about trading success, they often imagine advanced charting strategies, powerful indicators, or insider information. But the traders who survive and thrive long-term all share one trait: discipline. It's not flashy. It's not exciting. But it is the invisible superpower that silently separates the pros from the amateurs. Why discipline is non-negotiable. Discipline is the ability to stick to your trading plan, no matter how tempting it is to do otherwise. It's what keeps you from chasing a stock after it's already run 10% higher. It's what helps you cut a loss at 2% instead of praying for a bounce. And it's what allows you to walk away from the screens when there are no high-probability setups, rather than forcing a trade out of boredom. Undisciplined traders may win occasionally, but their success is erratic. It's built on impulse and emotion, not process. And without process, there is no edge. Discipline creates consistency, and consistency creates results. The myth of willpower. You don't need extraordinary willpower to be a disciplined trader. In fact, relying on willpower alone is a recipe for failure. Willpower fades. It gets tired. It can be drained by stress, hunger, and fatigue. What you need instead is structure. Pro traders don't discipline themselves moment to moment. They create a system of rules that disciplines them automatically. They have defined entry and exit criteria, risk management rules, a preset maximum daily loss, a checklist they run through before every trade. They build a framework that limits the need for real-time decision-making. And that is the real secret. Discipline in trading is often less about brute strength and more about creating guardrails you actually follow. The cost of indiscipline. Let's talk about what happens when you lack discipline. You take trades outside of your plan. You over-leverage. You revenge trade after a loss. You hold losers too long and cut winners too early. And slowly but surely, your edge, if you ever had one, erodes into dust. Point 1. Undisciplined trade rarely ruins a career, but the habits that form from repeated lapses will. It becomes a pattern. You become addicted to the thrill. The discipline fades, and with it, your control. Trading is not about doing everything right every time. It's about minimizing the damage when you're wrong and maximizing your consistency when you're right. That only comes from discipline. How to build trading discipline. Discipline is not a personality trait. It's a skill, and like any skill, it can be trained. Start with a simple plan. Your trading plan should be so clear that a stranger could follow it. Know your setups, your entry and exit points, your stop loss, and your position size. If your plan is vague, your execution will be undisciplined. Use checklists. Create a checklist you review before every trade. Did I identify the setup? Is the risk-reward ratio acceptable? Is this trade in line with my plan? Just like a pilot before takeoff, a trader must check every vital piece before executing. Limit daily trades or losses. Set hard stops, not just on trades, but on your trading day. For example, no more than 3 trades a day. Or, if I lose 2% of my account today, I walk away. These rules help prevent emotional spirals. Review your trades weekly. Discipline isn't just about real-time control, it's about reflection. At the end of each week, review every trade. Was it within your plan? Did you follow your rules? Self-review keeps your mind sharp and habits aligned. Remove temptations. If you know certain stocks, time frames, or chat rooms throw you off balance, avoid them. Your environment shapes your behavior. If Twitter is making you impulsive, log out during market hours. Create a workspace that supports clarity. The emotional layer of discipline. Discipline isn't just logical. It's emotional. It often means doing the harder thing. Walking away, sitting on your hands, admitting you were wrong, or skipping a trade. That looks tempting but doesn't fit your plan. These choices don't feel good in the moment, but they compound over time. Like compound interest, disciplined decisions build a resilient trading career. And here's the truth. The market doesn't reward how badly you want it. It rewards how consistently you show up with control, clarity, and composure. Becoming a professional decision maker. To trade like a professional, you must think like a professional decision maker. Every time you hit buy or sell, you're making a micro decision. When those decisions are rooted in emotion, overconfidence, or fear, the results are random. Discipline puts logic back in control. It makes your decisions predictable, calculated, and repeatable. Pros don't rely on excitement. They rely on edge. And edge can only be expressed consistently when discipline is present. Final thoughts. Discipline won't make every trade a winner, but it will ensure that your trading system, if it's built on real edge, has a chance to express itself. Most traders don't lose because their system is bad. They lose because they can't follow it.so. Remember, the best system in the world is useless without the discipline to follow it. But a simple system, followed with near-perfect discipline, can become a lifelong edge. Discipline is not loud. It doesn't crave attention, but it quietly builds something extraordinary. A consistent, confident, and calm trader who doesn't need luck to succeed. Discipline is your edge. Use it. Chapter 8. Learning from losses without losing your mind. Losses are inevitable in trading. They are not just part of the journey. They are the journey. Every successful trader has faced drawdowns, misjudgments, and unexpected market turns. What separates professionals from amateurs isn't the absence of losses, it's the presence of perspective. This chapter will teach you how to respond, not react, to losses in a way that sharpens your edge rather than dulls your discipline. Losses are tuition, not punishment. Let's begin by reframing losses. Most traders see a red trade and immediately jump to judgment. I'm not good enough. The market is unfair. Or worse, I need to win it back. These emotional reactions are rooted in ego, not education. Professional traders treat every loss as tuition, an investment in learning. They analyze, review, and adapt. Losses don't crush them. They teach them. Ask yourself, what did this trade teach me that a winning trade wouldn't have? That question alone can transform your relationship with risk. Detaching self-worth from trade results. One of the most dangerous psychological traps in trading is attaching your identity to your results. You are not your trades. A winning streak doesn't make you a genius, just as a losing streak doesn't make you a failure. The pro trader has learned to detach emotionally from outcomes. He or she understands that the market doesn't care about feelings, effort, or potential. It responds only to probabilities and patterns. And sometimes, even perfect setups result in losses. The moment you start defining yourself by your P&L, profit and loss, you become emotionally exposed. Detachment brings clarity. It allows you to trade from logic, not desperation. Emotional reactions multiply mistakes. Losses hurt. That's natural. But what you do after a loss matters far more than the loss itself. Amateurs react with revenge trades, doubling down, over-leveraging, trying to make it back. This mindset leads to spiraling losses. Professionals respond with review, reflection, and rest. If a surgeon makes a mistake during an operation, they don't immediately grab the next patient to prove they still know what they're doing. They assess what went wrong. The same applies to trading. Emotional reactions in the heat of the moment are rarely correct. Build in a buffer. After a loss, take a pause. Journal. Step away from the screen. Then return with a rational plan. The importance of post-loss review. Every loss is a story. Was it due to a poor setup, bad timing, news volatility, or was it simply random distribution? Having a trade journal is crucial. After every loss, record, entry, and exit points. Reason for entry: emotional state before and during the trade, market conditions, what went right or wrong. This post-loss review isn't about beating yourself up. It's about uncovering patterns. Over time, you'll identify habits that need fixing and strategies that need refining. The best traders are also the best analysts, not of the market, but of themselves. Cognitive biases that lead to misinterpreting losses. Humans are not naturally wired to handle trading losses. Several psychological biases make it worse. Loss aversion bias. We feel the pain of a loss twice as intensely as the pleasure of a gain. This skews judgment. Confirmation bias. After a loss, we seek information that justifies our mistake instead of learning from it. Recency bias. We assume that a few losses in a row define our future results, leading to hesitation or fear. Awareness of these biases helps reduce their impact. A professional mindset anticipates cognitive traps and chooses logic over impulse. The value of losing gracefully. Every time you take a discipline loss, you strengthen your mental edge. Why? Because you're showing yourself that you can survive uncertainty without breaking your rules. Graceful losing builds character. You exit when your stop is hit. You don't rationalize holding on just a little longer. You log the trade, accept the outcome, and move on. There is honor in that discipline. In a world that glorifies big wins, few understand the strength it takes to lose correctly. Stop loss. Not just a technical tool, but a mental oni. Stop loss isn't just about protecting capital. It's also about protecting clarity. Knowing your maximum risk before entering a trade reduces anxiety during the trade. It eliminates the panic of watching a position spiral out of control. Traders who skip stop losses often do so out of overconfidence or fear of being wrong. But pros know that protecting mental capital is just as vital as protecting money. Use stop losses as part of your mindset strategy. Let them free your mind to focus on process, not panic. Long-term thinking in a short-term game. Losses feel catastrophic when you think short-term. But when you zoom out, they're just blips in a much larger journey. Think of trading like a professional sports season. You won't win every game, but what matters is your average performance over time. Professional traders don't obsess over a bad day or even a bad week. They focus on long-term consistency. They understand that a single loss doesn't ruin them, but a poorly handled reaction might. That you're not just building a profitable strategy. You're building a resilient identity, reframing losses as data. In trading, data is gold. A loss is a data point, one that may be more valuable than a win. It tells you what setups to avoid when your emotions take over, which market conditions are less favorable, what parts of your system need tightening. When you view losses as research material, you transform pain into progress. Every loss becomes a stepping stone to refinement. This mindset shift is one of the most powerful upgrades you can make as a trader. Final thoughts. No one enjoys losing, but those who master the art of handling losses develop an edge that others can't fake. Emotional resilience, strategic review, long-term thinking. These traits turn you from an amateur with potential into a professional with power. Your job isn't to avoid losses. Your job is to learn how to use them. Chapter 9. Visualization and mental rehearsal. In the high-stakes arena of trading, your mind is your most powerful tool. While technical analysis, charts, and strategies provide the framework for your decisions, your mental state determines how effectively you execute those decisions under pressure. One of the most underutilized but incredibly effective techniques for preparing your mind is visualization and mental rehearsal. These techniques are widely used by elite athletes, military personnel, and top performers in every field. And they can be just as transformative for traders. What is visualization? Visualization is the process of creating vivid, detailed mental images of a specific event or series of actions. Instead of merely thinking about a trade, visualization involves mentally experiencing the entire process, from identifying the setup, placing the trade, managing it, and following your exit plan. When done properly, visualization engages your brain's neural pathways in much the same way as physical practice. It primes your mind and body to respond confidently when the real situation arises. Why visualization works? Your brain doesn't always distinguish between what's real and what's vividly imagined. When you visualize successfully executing a trade, your brain activates the same areas it would during the actual trade. This prepares your nervous system, calms your emotional responses, and builds confidence. In essence, visualization creates a mental blueprint that you can follow effortlessly. When the moment arrives, mental rehearsal. Practicing the process mental rehearsal takes visualization one step further. It involves repeatedly walking through the exact steps of your trading plan, especially focusing on the parts that challenge you. For example, if you struggle with cutting losses, mental rehearsal would have you vividly imagine identifying a losing trade, feeling the urge to hold, then consciously choosing to exit at the stop loss. By rehearsing this decision repeatedly in your mind, you reduce the emotional charge attached to it. When the real trade comes, your reaction is smoother, more automatic, and aligned with your plan. How to practice visualization and mental rehearsal. Find a quiet space. Sit comfortably in a quiet environment where you won't be disturbed. Close your eyes to minimize distractions. Relax your body and mind. Take a few deep, slow breaths to settle your nervous system. A calm mind is more receptive to visualization. Visualize your ideal trade. Picture the entire process from start to finish. Imagine scanning the charts and spotting your perfect setup. See yourself analyzing the risk-reward, placing your entry, managing the trade, and exiting according to your rules. Engage all your senses. Don't just see the trade, feel it. Hear the quiet click of placing the order. Sense the tension in your hands and the calm in your breathing. Feel the satisfaction of following your plan flawlessly. Include challenges. Visualize potential obstacles, a sudden market reversal, an emotional urge to hold a losing trade, or the temptation to deviate from your strategy. See yourself responding calmly and correctly. Repeat regularly. Consistency is key. Spend 5 to 10 minutes daily practicing this mental rehearsal, especially before trading sessions. Benefits of visualization for traders. Builds confidence. When you mentally experience success and disciplined reactions, your confidence grows naturally. You start believing in your ability to handle real market situations. Improves emotional control. Visualizing stressful scenarios and your composed responses trains your emotional resilience. Enhances focus and clarity. Visualization helps your brain organize information and focus attention on what truly matters. Reinforces your trading plan. Mentally rehearsing your rules embeds them deeper into your subconscious, making it easier to follow them instinctively. Visualization and the subconscious mind. Your subconscious mind plays a huge role in trading decisions, especially during high-pressure moments. Visualization works by programming your subconscious with positive, process-oriented behaviors. When the market moves fast and emotions rise, your conscious mind often can't keep up. Your subconscious takes over. If it's been trained with clear, disciplined patterns through visualization, you're more likely to respond appropriately without hesitation. Overcoming mental blocks. Many traders face mental blocks: fear of failure, fear of missing out, or paralyzing doubt. Visualization can help dismantle these barriers by repeatedly exposing your mind to successful, calm, and confident trading experiences. By mentally rehearsing your ideal responses, you create new neural pathways that weaken anxiety and strengthen certainty. Visualization is not magic. It requires discipline. Visualization isn't a shortcut or a magic trick. It requires intention and repetition. Skipping this step means missing out on one of the most powerful ways to prepare your mind. Treat mental rehearsal like physical training. The more you practice, the more natural it becomes. The more natural it becomes, the more automatic your best trading behaviors will be. Integrating visualization into your trading routine. Make visualization a part of your daily preparation. Before the market opens, take a few minutes to visualize your trading. Plan an ideal mindset. After losing trades or emotional sessions, use visualization to mentally rehearse how you'll respond differently next time. Use visualization to prepare for particularly challenging trading days or when facing a new strategy. Final thoughts: trading success depends on more than knowledge and analysis. It depends on your ability to perform under pressure. When emotions flare and uncertainty reigns, visualization and mental rehearsal train your brain to perform exactly when it matters most. They transform hope into preparation, anxiety into calm, and guesswork into confident execution. Your mind is your most valuable asset. Strengthen it through visualization. Prepare it through rehearsal. And watch as your trading transforms from reaction to mastery. Chapter 10. Thinking in Probabilities, Not Certainties. One of the most fundamental mindset shifts that separates professional traders from amateurs is the ability to think in probabilities rather than certainties. Markets are inherently uncertain, chaotic, and influenced by countless variables beyond anyone's control. Attempting to predict exact outcomes or expecting every trade to be a winner is a guaranteed recipe for frustration and failure. To succeed, you must embrace uncertainty and develop the discipline to operate within the realm of probabilities. Why certainty is an illusion? The desire for certainty is natural. Humans seek control and predictability to reduce anxiety. In trading, this manifests as the hope to know exactly where the price will go, to guess the top or bottom, or to believe in foolproof systems. But the market does not operate on absolutes. It's a complex system influenced by human psychology, global events, and random noise. Even the best analysis can't guarantee outcomes. Believing in certainty sets you up for disappointment and emotional turmoil when trades don't go as planned. What does thinking in probabilities mean? Thinking in probabilities means recognizing that every trade has a range of possible outcomes, each with its own likelihood. Instead of betting everything on a single result, you consider the probability that the trade will be profitable, the risk involved if the trade loses, the expected value of the trade over time. That it's about managing risk, not avoiding it. It's about stacking the odds in your favor and accepting that losses are part of the game. The role of edge and expectancy. Your trading edge is the advantage that gives you a higher probability of success over many trades. Edge can come from a sound strategy, superior information, or disciplined execution. However, edge does not mean every trade wins. Even the best edges only increase the likelihood of success, not guarantee it. Expectancy is a concept that ties into probabilities. It's the average amount you can expect to win or lose per trade over the long term. A positive expectancy means that, on average, your system is profitable despite some losses. By thinking in probabilities, you focus on maintaining positive expectancy and discipline rather than chasing perfect trades. How to apply probabilistic thinking in your trading? Accept the uncertainty. Start every trade knowing that the outcome is never guaranteed. This mindset reduces emotional attachment and helps you manage losses calmly. Use risk-reward ratios. Ensure that your potential reward justifies the risk you are taking. Favor trades where the upside outweighs the downside in a meaningful way. Calculate position size based on risk. Position sizing isn't about maximizing potential gains. It's about controlling losses. This helps you survive losing streaks and stay in the game. Focus on process over outcome. Concentrate on executing your plan correctly rather than obsessing over individual trade results. Over time, a good process leads to profitable outcomes. Diversify and avoid overconfidence. Don't put all your capital into one trade or strategy. Diversification helps spread risk and smooth out results. Overcoming the need for certainty. Many traders struggle with uncertainty because it creates discomfort. Here are strategies to manage that discomfort. Use stop losses religiously. This caps your risk and helps you accept losses as part of the probability curve. Set realistic expectations. Understand that losing trades are normal and necessary. Expecting perfection is unrealistic. Keep a trading journal tracking outcomes, and your thought process reinforces that even when trades fail, your edge can still produce profits. Practice mindfulness and emotional regulation. Being present helps you accept uncertainty without panic. Real-world example. The coin toss analogy. Imagine flipping a fair coin. Each toss has a 50% chance of landing heads or tails. You can't predict the next toss, but over many tosses, you expect about half to be heads and half tails. Trading is similar. Each trade is like a coin toss with odds slightly in your favor. Sometimes you win, sometimes you lose. Your goal is to have an edge that means more heads than tails over time. If you fixate on one toss or try to guess it exactly, you'll lose sight of the bigger picture. Avoiding binary thinking, beginners often see trading outcomes as black or white, win or lose, right or wrong. This binary thinking is limiting. In reality, trading is a spectrum of probabilities, outcomes, and decisions. You might take a trade that loses but learn a valuable lesson or improve your discipline. Or you might win a trade purely by luck but deviate from your plan. Thinking probabilistically helps you understand that no single trade defines your skill or success. The psychological benefits of probabilistic thinking reduce stress and anxiety. When you accept uncertainty, you release the pressure to be perfect. Improve decision-making. You make choices based on logic and data, not hope or fear. Greater resilience. Losses become less personal and easier to recover from. Final thoughts. Trading is not a quest for certainty. It's a journey of managing uncertainty with skill, discipline, and patience. Thinking in probabilities frees you from the emotional roller coaster of hoping for guaranteed wins. It empowers you to focus on process, control risk, and steadily build your edge. Remember, the market will never give you certainties, but it will reward those who master the art of probability. Chapter 11. Detachment from outcomes. The Zen of trading. In trading, success is often measured by results, profits, losses, winning streaks, or drawdowns. It's natural to focus on outcomes because they directly affect your account balance and your sense of achievement. However, an attachment to outcomes is one of the greatest psychological pitfalls a trader can face. It fuels emotional turbulence, impulsive decisions, and burnout. Detachment from outcomes. The ability to separate your sense of self and your decision-making process from the results is the foundation of what many call the Zen of trading. This chapter explores how cultivating detachment not only preserves your mental equilibrium, but also enhances your trading performance. Why attachment to outcomes is harmful. When you are emotionally tied to your trade's results, every loss feels like a personal failure, and every win becomes an ego boost. This emotional roller coaster can lead to overtrading to chase losses or capitalize on winning streaks. Revenge trading, where you impulsively try to make back what you lost. Fear and hesitation, which cause missed opportunities. Loss of discipline, as emotions override your trading plan. Attachment blinds you to the fact that trading is a game of probabilities, where no single outcome is guaranteed. Understanding detachment is not indifference or apathy. It doesn't mean you stop caring about your trades or results. Instead, it means you accept that the outcome of any individual trade is beyond your full control. Detachment allows you to focus on the process rather than obsess over the result. Respond to losses and gains with equanimity. Maintain mental clarity under pressure. Protect your emotional capital and resilience. It's the difference between trading to win and trading to trade well. The philosophy of Zen and trading. Zen philosophy teaches living fully in the present moment, without attachment to past failures or future outcomes. Applied to trading, it means being fully engaged in the decision-making process, accepting market unpredictability with calmness, letting go of the need to control or predict outcomes, cultivating mindfulness during every trade. This approach helps traders maintain balance in the face of volatility and uncertainty. Techniques to cultivate detachment: focus on the process, develop and follow a clear trading plan. Celebrate disciplined execution rather than profits. Each correct decision, regardless of outcome, is a win. Practice mindfulness meditation. Mindfulness helps increase awareness of your thoughts and emotions. By observing without judgment, you create space to choose your responses rather than react automatically. Set clear risk parameters, knowing your maximum acceptable loss per trade or day limits emotional exposure. When risk is controlled, detachment from individual outcomes becomes easier. Use affirmations. Remind yourself, I control my actions, not the market. Losses are part of the process. These affirmations build mental resilience. Keep A trading journal focused on decisions record not just results, but your reasoning and adherence to your plan. This shifts attention away from outcomes toward learning and growth. Visualize neutral reactions to gains and losses. Mental rehearsal can prepare you to experience both wins and losses with calm acceptance. The emotional freedom of detachment. Detachment liberates you from the fear of loss and the greed for gain. You become less reactive and more proactive. You no longer need to prove yourself with each trade. Instead, you trade from a place of confidence and peace. This emotional freedom reduces stress and burnout, enabling longer, healthier trading. Careers. Detachment does not mean lack of ambition. Some fear that detachment means complacency or lack of motivation. In reality, detachment supports sustainable ambition. It encourages you to focus on steady improvement rather than quick wins. It teaches patience, persistence, and humility to be why detaching from outcomes. You create space for clear thinking and better decisions, which naturally lead to better results over time. Real-world example. The calm trader. Imagine two traders faced with the same losing trade. The attached trader panics, overrides stops, and enters revenge trades. Their emotions spiral, clouding judgment. The detached trader acknowledges the loss, reviews the trade's adherence to the plan, and prepares calmly for the next setup. Which trader will last longer? Which will perform better over time? Detachment is the key. Final thought. Trading as a practice. Trading is more than a profession or a way to make money. It's a practice. Like any practice, it requires patience, self-awareness, and acceptance. Embracing detachment is a step toward mastering not just the markets, but yourself. It's a journey of learning to ride the waves of uncertainty with grace. When you trade with detachment, you no longer fight the market's unpredictability. Instead, you flow with it, and that is the true art of trading. Chapter 12. The routine of a pro trader. In trading, talent and strategy matter. But there is one ingredient that often separates consistent winners from the rest: routine. Professional traders don't rely on luck or sporadic bursts of inspiration. Instead, they build disciplined daily habits that create structure, focus, and reliability in an unpredictable environment. This chapter explores the routines that successful traders cultivate to keep their minds sharp, their emotions balanced, and their decision-making precise. Why routine matters in trading. Trading is a mentally demanding activity filled with uncertainty and rapid information flow. Without routine, it's easy to become overwhelmed, reactive, or inconsistent. Routine serves several essential purposes. Reduces decision fatigue. By automating many actions and rituals, you conserve mental energy for high-stakes decisions. Builds consistency. Following a daily plan helps you execute your trading strategy reliably. Enhances emotional stability. Predictable routines create a sense of control and calm amid market chaos. Supports continuous improvement. Dedicated time for review and learning fuels growth. Morning preparation. Setting the stage. Most pro traders start their day well before the market opens. Morning routines often include reviewing overnight news and market conditions. Understanding global events, economic releases, or geopolitical developments prepares you for market sentiment shifts. Checking your trading plan and goals. Reminding yourself of your setups, risk parameters, and objectives helps anchor your focus. Mental and physical warm-up techniques such as meditation, stretching, or breathing exercises calm nerves and sharpen concentration. Visualization. Mentally rehearsing your trades and emotional responses primes your mind for the day ahead. During market hours, staying disciplined. Once the market opens, routines shift toward maintaining discipline and focus. Following a predefined watch list. Monitoring select instruments prevents distraction from irrelevant noise. Using checklists before each trade. Confirming setup criteria, risk-reward, and position size reduces impulsivity. Taking scheduled breaks. Short breaks help reset your mind and prevent burnout during intense sessions. Logging trades immediately. Recording your reasoning and outcome while fresh ensures accurate reflection later. After market close, reflection and recovery. The day doesn't end when the market closes. Evening routines solidify learning and maintain balance. Reviewing the day's trades. Analyze what went well, what didn't, and why. This feedback loop sharpens your process. Updating your trading journal. Document emotions, mistakes, and successes to identify patterns. Continuous learning, reading, watching market analysis, or studying new strategies keeps you evolving. Physical exercise and relaxation. Trading is mentally taxing. Physical activity and downtime restore energy and reduce stress. Week and month-end reviews beyond daily routines. Pro traders schedule regular reviews. Performance metrics analysis tracking win rates, risk-reward ratios, and drawdowns highlights. Strengths and weaknesses. Strategy adjustments. Data-driven tweaks improve your edge. Mental and emotional check-in. Assess burnout signs or emotional imbalances and address them proactively. The role of rituals and routine. Rituals are small, deliberate actions that prepare your mind and body. Examples include lighting a candle or incense to mark trading time, wearing a trading hat, or specific clothing to get into the mindset, starting with a specific music track or sound to signal focus. Rituals create psychological cues that enhance concentration and discipline. Flexibility within routine. While routine is crucial, rigid schedules that ignore real-world changes can backfire. Pro traders build routines that are flexible and adaptive. For example, if unexpected news impacts the market, they adjust their plan but maintain core habits like risk management and journaling. The invisible edge of routine may seem mundane compared to flashy strategies, but it provides an invisible edge, mental clarity, emotional balance, and consistent execution. In a field where many traders fail due to inconsistency and emotional reactions, routine is the steady foundation that supports success. How to build your trading routine. Start simple. Don't overhaul your life overnight. Begin with a few core habits like pre-market review and post-trade journaling. Be consistent. Aim to follow your routine daily, even on non-trading days, to build habit strength. Adapt as needed. Adjust your routine based on what works best for your personality and schedule. Use reminders and tools. Alarms, apps, and checklists can help maintain discipline. Reflect and improve regularly. Assess your routine's effectiveness and make changes to optimize performance. Final thought: the market is unpredictable, but your routine doesn't have to be. By creating and committing to a structured trading routine, you equip yourself with the mental toughness and consistency necessary to thrive. Trading is a marathon, not a sprint. Your routine is the steady pace that carries you through. Chapter 13. How to rewire your mindset for long-term success. Trading is as much a mental game as it is a technical one. The strategies, indicators, and systems you use can give you an edge, but without the right mindset, even the best tools won't bring consistent profits. Rewiring your mindset for long-term success means transforming your thoughts, beliefs, and habits to align with the realities of the market and the demands of disciplined trading. This chapter will guide you through the psychological shifts and practical steps necessary to build a resilient, growth-oriented mindset that sustains you over years and through all market conditions. Understanding the current wiring. Before rewiring your mindset, you need to understand the existing programming that may be limiting you. Many traders enter the market with fixed mindsets, believing that skills and intelligence are static. When faced with setbacks, they feel defeated. Emotional reactivity, allowing fear, greed, or frustration to dictate decisions. Overconfidence or doubt, swinging between extremes, leading to impulsive actions or paralysis. Short-term focus, chasing quick wins rather than building consistent, sustainable growth. These mental patterns create barriers to success. The goal is to replace limiting beliefs with empowering ones and cultivate habits that support consistency. The power of neuroplasticity. The brain's ability to rewire itself, known as neuroplasticity, is your ally in this transformation. Through deliberate practice and repetition, you can form new neural pathways that support calmness under pressure, rational decision-making, patience, and discipline. Resilience to losses. Understanding this capacity encourages patience and persistence. In mindset work, it's a process, not an overnight fix. Core mindset shifts for traders from fixed to growth mindset. Adopt the belief that your skills and intelligence can improve with effort and learning. View mistakes and losses as opportunities to grow, not as failures. From emotional reactivity to emotional regulation, train yourself to recognize emotional triggers and respond consciously rather than react impulsively. Techniques such as mindfulness and breathing exercises help. From outcome attachment to process Orientation focus on following your trading plan and executing your edge rather than obsessing over individual trade results. From short-term fixation to long-term perspective, develop patience and the ability to tolerate drawdowns, knowing that consistent execution yields profits over time. From perfectionism to practical excellence, accept that not every trade will be perfect. Aim for continuous improvement, not flawlessness. Practical strategies to rewire your mindset. 1. Daily affirmations and positive self-talk. The language you use internally shapes your beliefs. Replace negative, self-defeating thoughts like, I always lose, or I'm not cut out for this, with positive affirmations such as, I am learning and improving every day. I trade with discipline and patience. Losses are part of my growth. Consistency in affirmations rewires your subconscious mind. Point 2. Mindfulness and meditation. Mindfulness trains your attention and reduces emotional hijacking. Regular meditation, even just 5 to 10 minutes daily, helps you observe thoughts without judgment, reduce stress and anxiety, enhance focus and clarity during trading. With time, mindfulness becomes a mental anchor in volatile markets. Point 3. Visualization and mental rehearsal. As discussed earlier, visualizing successful trades and emotional control programs your brain to respond effectively under pressure. Repeat mental rehearsals help solidify new neural pathways aligned with disciplined behavior. Point 4. Journaling your thoughts and emotions. Maintain a trading journal that includes not only trade data, but also your emotional and mental states. Reviewing this regularly reveals patterns and areas for improvement. Point 5. Setting incremental goals. Break down long-term success into small, achievable goals. Celebrate mastering a new habit, following your plan for a week, or improving your emotional responses. Incremental progress builds momentum and confidence. Point 6. Learning from role models and mentors. Surround yourself with traders or communities that embody the mindset you aspire to. Learning from their experiences accelerates your growth and provides accountability. Overcoming common mental roadblocks. Fear of failure. Reframe failure as essential feedback. The more you face it constructively, the less power it holds. Impatience. Use routines and rituals to create structure. Remind yourself that mastery takes time. Self-doubt. Record your successes, no matter how small, and revisit them regularly. Overtrading impulse. Rely on checklists and trade limits to curb impulsive behavior. The role of habits and mindset. Rewiring mindset isn't just about thoughts, it's about behaviors. Habits are the bridge between intention and action. Create daily habits that reinforce your desired mindset. Reviewing your trading plan every morning. Performing pre-trade mindfulness exercises. Logging every trade with reflections. Taking regular breaks to reset. Focus. Consistency in these habits physically rewires your brain over time. The long game. Patience and persistence. Rewiring your mindset is a journey. You will face setbacks and moments of doubt. The key is persistence. Like compound interest, small daily improvements accumulate into profound change. Remember, even the most seasoned traders continue this mental work throughout their careers. Final thoughts. Your mindset is your greatest trading asset. By intentionally rewiring it, you build a foundation of resilience, clarity, and disciplined execution that withstands market storms and psychological challenges. That long-term success isn't just about what you trade, it's about how you think. Conclusion: no more luck. Trade with purpose. As we reach the end of this journey through the mindset and skills necessary for professional trading, it's clear that trading is not about luck. It's about cultivating purpose, discipline, emotional control, and strategic thinking. The markets are complex and unpredictable, but your approach to them doesn't have to be. Trading is a choice between luck and mastery. Many beginners enter trading hoping for a quick win, a lucky break, or a shortcut to wealth. But the truth is, luck is unreliable, fleeting, and outside your control. Relying on luck leaves your success to chance and exposes you to unnecessary risk. Trading with purpose means choosing mastery over chance. It means committing to a process, building the right mindset, and consistently applying proven principles even when the market tests you. The elements of purposeful trading. Purposeful trading is rooted in clear goals. You know what you want to achieve and why. Your goals guide your plan and keep you grounded through challenges. A robust trading plan. You have defined criteria for entries, exits, risk management, and money management. Your plan is your compass in volatile markets. Discipline and routine. You follow your plan with unwavering commitment and use routines to maintain focus and reduce emotional interference. Emotional mastery. You recognize and manage fear, greed, impatience, and other emotions that can cloud judgment. Learning and adaptability. You treat losses as lessons, embrace continuous learning, and adjust your strategies as markets evolve. Thinking in probabilities. You accept uncertainty and make decisions based on odds, not certainties. Detachment. From outcomes, you execute trades without attachment to results, maintaining calm and clarity regardless of profit or loss. Trading is a marathon, not a sprint. Success doesn't come overnight. It's built gradually through consistent effort, reflection, and growth. There will be setbacks, frustrating days, and moments of doubt. But with purpose, these challenges become opportunities to deepen your skill and resolve. Your mind is your greatest asset. Above all, remember that your mindset shapes every decision you make. Rewiring your mind for discipline, patience, and resilience creates the foundation upon which all other skills rest. By choosing to trade with purpose, you step away from the gambler's hope for luck and into the role of a professional trader, confident, prepared, and in control. Take action. From knowledge to execution. The knowledge you have gained in this book is powerful, but knowledge alone won't change your trading results. The key lies in action. Develop your personalized trading plan. Build routines that support your mental and emotional health. Practice visualization and mental rehearsal. Embrace losses as feedback and continue learning. Think probabilistically and manage risk. Cultivate detachment and trade with calm confidence. Each deliberate step moves you further from luck and closer to mastery. Final thought: the markets will always contain uncertainty. No one can control every variable or predict every move, but you can control how you respond. Trade not as a gambler hoping for luck, but as a professional operating with purpose, discipline, and clarity. No more luck. Only skill. Only mindset. Only you. Your journey to becoming a pro trader starts now.